Welcome to this week's Credent Connect series, and today we're going to focus again on markets and the economy, but more specifically kind of step back in time a little bit and reassess our views that we released in December of 2022 as it relates to our view of 2023. Being now we're in September, we spent some time going back and really analyzing the segmented exposures of what we thought was likely to pan out this year from a markets and economic standpoint. And if you recall, that piece, which is available on our website, is segmented into three areas defined by increasingly optimistic, where we touched on three components there, our neutral components, kind of things that we thought would likely go sideways, maybe stagnate, and of course, risks and uncertainty. And we're going to cover one or two pieces in each one of those very briefly today. And of course, I do want to start with the increasingly optimistic piece because this was a continuation of what we listed as increasingly optimistic for 2022, and it made its path into 2023 very appropriately so. So, Alicia, talk to us a little bit about that being consumer consumption and the consumer in general, why we went with increasingly optimistic at the beginning of the year, rather December of last year into this year, and kind of where we stand today on that.
Okay. So the consumer has been really resilient. They had a lot of excess savings. They have had wage increases, so they've been able to consume a lot more. One of the things that we found interesting was during 2022, when the consumer was doing pretty well, they had such a dour sentiment. So when we actually had a one-pager on this where we talked about consumer sentiment being at the lowest level ever, worse than COVID, worse than 9/11, worse than 08/09. And we just didn't really feel that was justified. And so in this piece, we talk about consumer sentiment kind of rebounding. And it's really come to fruition so far this year. So consumers are feeling better now that inflation is falling, even though monetary policy is still pretty tight.
That's a great point. You know, one of the things to add to that, one of the biggest groups that was actually surveyed in the sentiment data of 2022, which was worse than the global financial crisis, which is unbelievable to even say out loud, the millennials, right? Millennials are at that stage where now they have spending money. Most of them do own homes. They're in that consumption category group. They've never lived through a recessionary potential, really dramatic when they have full-time jobs, inflationary pressures of anything of that nature. So this was truly a kind of disequilibrium landscape. Thank you for that. All the neutral piece, one of the things we wanted to talk about that we put on the neutral category was the labor market, right? And the labor market has been interesting in the fact that the Federal Reserve has not been able to kill the labor market despite the ongoing increases in interest rates. What has happened, however, is we are seeing a normalization of the labor market, okay? But normalization relative to killing the labor market are two drastically different things. Normalization implies more of a sustained long-term path. Yet what the Fed was trying to do, increase unemployment, increase jobless claims, that hasn't really come into fruition. And we're actually teetering at that around 5% unemployment rate, which has always been the neutral unemployment rate, kind of that full employment status. So we did put it in a neutral category that has panned out as expected on this front, given that tight monetary policy backdrop. And we don't think that's a risk, by the way, moving forward. We still have roughly 1.5 to 1.6 open jobs per individual seeking employment. That's actually better than pre-COVID in the current normalization of that labor market. And lastly, shifting into that risk and uncertainty area, right, which is where most investors tend to naturally live in, right? Most of us are risk averse in that nature. Risk and uncertainty tend to grab our attention more. Let's talk a little bit about the R word, right? The recession word has been talked about, the past 18 months nonstop. Where are we at? Why has it not happened yet, Alicia? And what can we look forward to?
So coming into 2023, we saw recession calls all the time. We're going to have a hard landing. Everyone was very pessimistic coming in, so all the expectations were really poor. And what we've come to realize is those expectations were incorrect. So now what we're seeing in 2023 is all of these economists pushing out their recession calls into the end of 2023 and into 2024. And we're really in that camp as well, thinking, we think a recession is likely, but we think it will have those soft landing undertones to it when it does come.
Yeah, those economists will be right at some point, I promise you, right? Just keep pushing that call out. One of the things we talked about in our risk and uncertainty on the recessionary backdrop is the fact that don't anticipate the stock market to do poorly amidst the recessionary backdrop or amidst the recessionary calls. The two are different, right? One's consumption-based, one's production-based, and there is that short-term deviation. We are 100% seeing that so far this year. And based on the consumption patterns of consumers, based on the normalizing labor market, not a deteriorating one, that soft landing of a recessionary backdrop, whenever it comes, we do believe that to be a fairly positive, if not neutral, for the markets.